In part today. Mike Ryan is Divisional Vice Chairman with UBS Global Wealth Management. Mike, are you ready to ride with the value crowd or what?
Well, first of all, Kyle, let me kind of add my voice to the chorus here and some of the things I just heard. I do agree that we're seeing is a pretty sharp rebound in the cyclical outlook, and I think therefore small caps, mid caps are likely to outperform large cap. I also think that also augurs well for some of the cyclical sectors when we're talking about financials, energy, industrials as well. And those tend to be more value-oriented sectors, if you think about it. So I do agree that as interest rates continue to rise, as growth begins to normalize, that gives more momentum now for the value part of the market rather than growth. Now, I think it's a little too early to say that we're at a sustained breakout for value, but I do think going forward, increasingly what we see is what have been the tailwinds for the growth sector are increasingly abating, and it provides more support now for the value sectors.
So that sustained period of outperformance by growth is one thing. Maybe it is fading, but you're not quite so confident just yet that a sustained period of outperformance is in the cards for value stocks.
Yeah, I think one of the things you do need to see here in terms of, and this was mentioned by one of the other guests you had on before, I do think we need to see interest rates continue to move higher. And by the way, if interest rates are rising, not just because of higher real rates, because of inflation, that does create some headwinds for value stocks as well. So what we need to see to real sustained breakout in terms of value versus growth, I need to see not only rates rising, but it has to be a real rate momentum moving as opposed to simply a resetting for inflation expectations.
Are interest rates rising for the right reason? In other words, because there is more inflation on the horizon, and how much inflation are you expecting?
So that's a really good question. First of all, I think as we track what's happening so far and what we expect to happen with regard to both interest rates and inflation, I do think rates are resetting, and I think they are resetting for the right reasons. What we have seen is we're starting to see more and more progress towards containment of COVID, and also in terms of the efficacy of the vaccines, which is a really important turning point for the economy. It means some of the social distancing and mobility restrictions can be lifted. And as growth normalizes, we are expecting to see rates begin to move. Now, there's a couple of things, Tyler will put a governor on that. First of all, the Fed has made it really clear that they're not going to move very quickly in terms of resetting policy. So I think what we'll see is there'll still be an anchoring, certainly on the short end of the curve. But as business prospects improve, we do expect to see real yields throughout the rest of the curve begin the resetting process. One of the reasons why we don't see a real breakout of yields and we don't see a surge in interest rates is because we do believe that inflation is going to remain relatively well contained, and therefore we don't see the kind of spike above, say, 2% that would be more alarming both for equity market valuations and also for growth down the road as well.
Shepard Smith here. Thanks for watching CNBC on YouTube.